Good day, everyone. Thanks for joining today again. I hope everyone is having a great day, fantastic week so far. I firstly wanted to say thanks for getting this channel to over 100 subscribers within, I'd say that growth spurt was within about a week and a half, 2 weeks, and the channel just kind of blew up. Um, yeah, I wanted to say thanks for the support, and I intend to continue to produce more content that is deemed as valuable, insightful, and easy to understand. What I wanted to share with you today was the concept of order blocks. I'll be doing a mini series on order blocks, so I won't be doing everything in this video today. I will just go over what is an order block and how they are created and what is the logic behind an order block. I crave your continued support as we grow together and become the best version of ourselves. Let's get into it. What is an order block, right? It's a block of orders, basically, which is created by the large institutions in the market, such as the big banks, the hedge fund, traders, and so on. And because of the volume in the transactions that they do, meaning the amount of money that they enter into the market on a daily basis, it is difficult for them to just, for example, like how we would look at analyze the charts, see an opportunity, place an entry, and it's so easy for us to just place an entry in the market. For them, it is a little bit more difficult because of the amount of money that they cycle every day through the system, and so they have to basically be strategic in how they place their orders and how they open their positions or close their positions. And for example, as we're looking at the chart here, starting from here, we are in a downtrend, right? We can clearly see that price is going down, even though there would have been pauses, pullbacks, retracements. It's a downtrend, right? So we clearly see that. Now, order blocks are strong enough to reverse the market or cause retracements in whichever direction opposite to where the market is heading. And for example, an order block would have basically caused from this push here upwards would have been an order block here. There's an order block here. There's a retracement, but expectationally we're expecting another high to break these highs, but that did not happen. The market started to fall down. This block is what we would call a breaker block, but I'm not going to speak about that today. As I said, it will be a series, so I will go over the different types of order blocks in another video. But just to give you an idea and to simplify the concept. So this is an order block here, which would have caused this move down. So it's the last bullish candle. In the case, this is a bearish order block. So it's the last bullish candle that before the down move. And so this would have been, you would have noticed that the candles are large. They're engulfing, they're full of volume, meaning they have less wicks, and there's a momentous move downwards. That signifies that this is an order block, right? To identify a bullish order block, for example, this would be a bullish order block right here. So whenever the banks are at play in the markets, you will know the difference because of the volume in terms of the size of the candles, because the candles represent the volume in terms of liquidity in the market and the money being circulated in the market. So whenever they enter into the markets, because of the size of the positions that they enter in, it tends to shift the market in a very obvious way, and you get larger candles, more momentous candles, and they tend to be formed really fast, right? So when the candles are formed from the order block, you usually have imbalances and inefficiencies left, which the bank has to come, which price has to come back and um, mitigate and fill imbalances and inefficiencies, and then continue on. But it's not always the case that price will come back immediately. Sometimes price will continue on and then come back at another later date, depending on the time frame that you're on. We're on the daily time frame now. um, Things can take time to happen because this would be 1, 2, 3, 4, 5, 6, 7, 8 almost, and this would be more than a week. So it takes time depending on the time frame you're on. But it's best to look for your order blocks on the higher time frames because they're more likely to be valid from the higher time frame, from the weekly, daily, 4 hour, especially. So with those two examples of what an order block could be, I would just go over maybe a couple more examples to show you. Um, if we notice, we have this swing. There's a swing coming up, another swing, and the swing comes down here. It's a swing because these are substructure candles. The main structure will be here, here. This is a swing point. This is a swing point. This is a swing point. In this swing point, we notice that we have this doji candle. Then we had this bull candle, then we had this bear candle, and then we had these momentum candles going up. Sorry. With that, we would mark this doji here as the order block because of the fact that it is the last bearish candle before the momentous move up. And this would make this an order block. Let's identify another one. Here's a bearish order block right here. Um, the last candle before the big move down. In this case, this one broke structure, and this is significant break of structure because we're on the daily time frame. Going down, you would have found other order blocks within this order block when we were refining our order blocks, trying to get a better entry in terms of a risk to reward ratio. This would be another order block here. And I'll go over the reasoning or the logic behind the creation of order blocks, right? And why sometimes they create the manipulations or inducements that they do. So for example, let me find an example. Okay, here's an example. All right, we saw, because sometimes the order blocks, as I said, they can cause reversals or they can cause retracements, not necessarily a change in the direction of the market, but more of a retracement and then a continuation. So this is an uptrend, for example. We can clearly see that price is going up. There's a consolidation period here, continued up, came down and continued up. Now in this move up until this point, we can see from here right across that, let me move this out of the way, we have this area of consolidation, right? All of this. Equal highs, equal lows. Now, to give you the logic of why the order blocks are created. As I said, the bank cannot just enter into a position as they feel like. There are strategic ways in which they enter the market. So, for example, if they're looking to buy into this uptrend, they want price to continue in the same direction because the truth is they have the power and the wherewithal to change the direction of the market and set things how they want to. And because of the volume that they trade with. And so they didn't necessarily want to change the direction of the market, but they wanted to enter possibly at a better price, a discounted price. And so the in the move up, this little area here would have been where they would have created some liquidity because if they are looking to buy and there are no sellers in the market, what do? They create the inducement Retail traders who trade the retail strategy would be looking for double bottoms, double tops. They would be looking for equal highs, equal lows, and they would be looking for trend lines and so on. These areas like those are where liquidity is generated or created. And with those areas, that's where you'll have buy stops and sell stops. In this case, it will be sell stops because of the trend. It is more logical that a person would, looking at the support area here, would be buying into this trend. With that, there are sell stops, millions of dollars sitting, resting in sell stops here. What does the big bank do? The big banks now, they create the inducement, then they sweep the liquidity with this candle here, um, right here. So they would have created that scenario so that they can be able to get the sell stop so that they can be able to buy into the market because they have to buy from somebody who is selling. If there's nobody selling because everybody is buying into the uptrends and there's nobody selling. So they had to create the opportunity for themselves to be able to buy because the fact is supply and demand is what really runs the market. And in any financial or any market in the world, supply and demand is the balance there. So without the supply, there's no demand. Without the demand, there's no supply, basically. And so they grab liquidity here, or did a draw on liquidity here. Now they have the sells to enter the buys to be able to keep price going up, and they would have gotten in at a discounted price here. So this would have been an order block because the banks would have entered a buy right here in this candle. If we extend this out, we notice that price came right back into this area, almost exact. Let me remove the ellipse. Right, so, right. So we can see clearly price came almost back into the same area, if not exactly. Why did that happen? Because they had opened their sell positions because they're the ones who created the sell here. So these positions would have been opened, still open when they enter the buy here to keep price going up. So they had to come back to close out these positions to either get close out at break even or to close out maybe even in some profits, which they would have closed in profit here. If it was break even, would have been at the top of the candle. And so once they did that, came back, that's called mitigation. Once they came back and mitigated their positions here, price flew up and then just continued in the direction that they had intended it to go anyway. And that's one way in which order blocks can be used. As I said, there are other types of order blocks, but I won't make this video lengthy. I will just keep it to the fact that I want to show you what order blocks are and how and the logic behind how they're created, how they're formed, and I will show you also in another video in this series how you can use order blocks to get sniper entries, how you can use them to get the best entries, the more probable setups, and how you can find high probability order blocks when you're looking for your setups to trade. Just to make it clear, let us one more time go over examples of order blocks because there are also order blocks that are called bullish, bearish, bullish order blocks or bearish, bullish, bearish order blocks. This would have been an example here. You had the bullish, bearish, bullish order block in the uptrend going up. So order blocks are just simply some in this case an uptrend. You see an odd bear candle. That's an order block. That's an order block. It doesn't always have to create momentum, but it is just that we have to be able to decipher which ones are valid when we're looking for a point of interest to trade. So this is a bullish, bearish, bullish. There are also bearish, bullish, bearish. Let me see if I can find one. Um, this is bearish, bullish, bearish, right? And yeah, and then you'll have this order block. This is an order block. Um, that's an order block. This is an order block. So the last bull candle before the down move, last bull candle before the down move, the last bear candle before the up move, and so on. The last bull candle before the down move, the last bull candle before the down move, and those are order blocks. The last bear candle. In this case, let me explain why I didn't highlight this bear candle. This doji would have been the last candle. Because it's a doji, we're going to use this candle instead because it is a doji and it is the last candle before you see the momentum candles that have volume and are engulfing and give you a huge push upwards. So we would have used this as the order block instead of this bear candle. And that's an example of that, how you would use doji in this case. Yeah. And I think that would be this is an order block as well. No, actually no. It's not. Um, let's skip that. This is an order block. This is a bearish order block. This is a bullish order block. And I'm sure you get the point. But what I will do, I didn't expect this video to be so long, but yes, I will go over next how you can identify valid zones because order blocks are basically supply and demand zones as well. So you can use them in that respect as well if you understand that concept more. And yeah, we'll go over how you can find high probability order blocks, what makes them high probability, what makes them more valid, what makes the setups better, and we'll also go over the types of order blocks and how you can use the different types to get entries that are very good in your trading setups. I hope this video was helpful and valuable to you, and I look forward to speaking with you again sometime further down in this week. Thanks for watching and take care. Bye bye.